Welcome to XM.com. This is the weekly outlook, and it's going to be a very busy week for FX traders with U.S. inflation on the upcoming week's agenda, as well as the official nomination for the Bank of Japan next governor. I'm Cristina Marujos. With me today is our senior investment analyst, Mario Sachigiriakos. Mario, starting with Japan, earlier this week, Masayoshi Amamiya had been the front runner to succeed Kuroda, but the latest headlines suggest that the Japanese government is planning on appointing Kazuo Ueda, economist and former member of the Bank of Japan Policy Board. Of course, the yen rallied on the news, so what could the upcoming week have in store for the Japanese currency?
Hello, Christina. So you're right, we got a surprise sort of leak in the newspapers, in Japanese newspapers, that it's not going to be the front-runner, Amamiya, who was considered quite dovish. He was seen as a continuation of the current extreme stimulus policy. He was there for most of it as well over the last decade. So when the markets got the news that it won't be him and it might be Ueda instead, the yen started to rally quite substantially. And the thinking is the following. We don't know Ueda's views on policy. But what we do know is that he is not a current member of the Bank of Japan, and he was not involved in the extreme stimulus policies of the last decade. So the thinking is that he could be more open to raising interest rates. Now, here's the big picture. I think that the outlook for the yen is quite positive, regardless of who is governor of the Bank of Japan. And the logic is the following. What matters the most for the yen is the economic landscape. And the Japanese economy is doing much better lately. Inflation has fired up. It's at a 4-decade high. Wage growth has taken a similar route. Wages are growing at a 4% more or less from last year, that is the missing link that the Bank of Japan wanted to see. Wage growth firing up. That was what policymakers wanted to see before they made more policy adjustments. So I think that the Bank of Japan is on track to keep tightening policy, and the next adjustment might be in March. And of course, speculation about that could begin earlier. Now, overall, we've got a situation where the Bank of Japan is tightening policy while other foreign central banks, like the Fed, the European Central Bank, most are about to conclude their own tightening cycles. We also have global economic growth losing steam. So overall, this investment environment, I think, favors the yen. And I think that interest yield differentials could continue to compress to its benefit.
Let's stay on the FX front. The next test for the U.S. dollar is without a doubt the CPI report, which is out on Wednesday. Investors, of course, expect further cooling in inflationary pressures. What could that mean for Fed hike expectations moving forward, and how could the dollar perform this week?
Well, the dollar, Christina, has staged a little bit of a comeback lately. We've seen a substantial recovery, and that came on the back of some strong data releases from the US. So specifically, we got a very strong non-farm payrolls report. We got a strong ISM services survey, and investors concluded that the US economy remains very resilient, so the Fed might need to do more on interest rates. So specifically what happened is markets have priced in a higher for longer scenario for interest rates. Market pricing suggests that we are going to hit 5.1% in terms of rates, and that interest rates are going to stay there until the end of the year. And of course, some rate cuts that were priced in for the end of this year, some of those have been priced out. And the market right now thinks that any serious rate cuts are more of a story for 2024, for next year. Now, the logic behind all of this is that since the jobs market is so exceptionally tight, inflation could return for a second round, and that might force the Fed to stay tight for a longer period. So this repricing helped the dollar to come back to life, but whether the recovery persists, Christina, ultimately depends on the upcoming inflation report and whether it validates the narrative that we just described. So expectations are for another slowdown in inflation in yearly terms. And that is supported by business surveys as well that showed companies raising their selling prices at a slower pace. In fact, the slowest pace in more than 2 years in January. However, I see some upside risks to the inflation forecast, mostly because of what the Cleveland Fed has a model that tries to track inflation. And that model is pointing to an upside surprise in inflation. So I would be on the lookout for something like that. And of course, for the dollar to continue to rally, the market would need to see a hotter than expected print.
It's going to be another exciting week. Marios, thank you so much. This was the Weekly Outlook here at XM.com.